Hey everyone, welcome back to another episode. I'm here with Chris from Maven Cost Segregation. Welcome to the show, Chris.
Hey, how's it going, Hunter?
Great. So I found you guys online when I was looking for interesting guests, and I wanted to have somebody on that could talk about cost seg. So me, myself, I'm a land flipper, so I haven't personally done any cost segs before, but I do know people that have done it in the real estate space, and you guys are professionals. So
Yeah, absolutely. So in a nutshell, high level, I help real estate investors accelerate their depreciation in their properties that they buy so that they can get a bigger tax write-off on their taxes at the end of the year. That's our whole goal. And we do that through what's called a detailed engineering study for cost segregation, or a detailed cost segregation study.
How did you get into this, and what's your background with this? Do you have an interest in real estate and doing these cost segregation studies? And how did you come across this?
Very, very good question. I love real estate. I think it's a fantastic avenue. And there's so many amazing pillars to it where you get the appreciation, the leverage, cash flow. Everybody kind of has their favorites. That's my favorite question. Is it the leverage, cash flow, the appreciation, depreciation? What's your favorite? I might be biased. I like the depreciation a lot, but that's obviously what I help people accelerate a lot of the time. But I first came into this because I was kind of a part of the silver tsunami a little bit. I had bought a boring business. It was running out of my house at the time. And we started to look into expanding into our own facility. And it was at a meetup for a mastermind that I was a part of where I met Sean, the owner of Maven. And he was like, hey, when you get a new building, let's talk. I can probably reduce your tax bill a bit through cost seg. And that was what made me just really interested. I never really dove into reducing a tax bill and the different strategies the 1% might use to reduce their tax bill. And this is certainly something that any of the 1%ers are actively pursuing, is cost segregation. A lot of their investments are going to be spent in real estate for wealth preservation. And this is a massive way that they legally reduce their taxes in a very profound way. So that was my intro into it. As Maven grew and I was going through some transition out of that other company that I purchased, Sean had asked me if I wanted to join in and help him continue to grow. So that's what I've been doing now for the better part of the last year.
Very cool. So it all kind of flowed together to where you are now.
Yeah. So when you buy a normal investment property, like a house, we'll just say it's a long-term rental, you're going to passively invest in it. When you buy that property, there is depreciation that comes with it. Because you're an investor, the IRS allows you to take depreciation. Technically speaking, it's what's called a non-cash expense. And it's a way that the IRS is essentially saying hey, we know buildings break down. We don't want that to happen. And here's a discount on your taxes each year so that you can continue to put money back into the building and improve the property. IRS wants, and in general, the government wants properties to improve, not to just be completely, repeatedly deteriorated and falling apart. So for investors, they can come in and they get this extra bump. Well, by default on that long-term property that you bought, you're going to be taking the depreciable basis, or roughly the purchase price, less the land, and spreading that out over the next 27 and a half years. So it's kind of like a coupon the IRS gives you to get your purchase price on that property back over that period of time, which is awesome. Little cashback rebate. That comes in the form of a pre-tax deduction on your taxes. So it lowers your taxable income, and then your effective tax rates are hit whatever taxes you're at. Mm-hmm. So let's say you bought that long-term rental at $500,000. We'll say land came in at $100K, so 20%. So we have a $400,000 depreciable basis. What that means over the 27 and a half years, the IRS will let you write off that full $400,000. But because it's every year, there's a small deduction. Well, if we did a cost segregation, the actual process of a cost segregation is where we have engineers come through and we recategorize the different components in your property that the IRS and other parts of the code has already said depreciate faster, not over 27 and a half years. So great example, carpet, flooring, cabinets, they all depreciate over 5 years. They're considered personal property. So we come through, we figure out the total cost of everything, we recategorize that, and we can typically accelerate 25 to 35% of a depreciable basis. And with current tax law, there's some bonus incentives that can be applied. At the end of the day, if you buy that property and you do a cost segregation, instead of what might be a $18,000 a year deduction you would take for 27 and a half years, we would be able to get you a $100,000 deduction in the first year. And then the remaining years, you'd have like $10,000 or $12,000 deducted. So you can still do some compounding with your acquisitions, but that puts a lot more money back into your pocket right away. And if you're in like a 37% tax bracket, I use high incomers just because it's easy math, then you're saving $37,000 on your tax with a $100,000 deduction.
Yeah. So it's a great way for people to get more money back up front. And then you still have depreciation on the rest of the asset over the remaining 27 and a half years. It's just it's about what, 20 to 30% on average that you get the first year back, or?
Yeah, I'd say if there's like a true average, it's like right around 29%. And that is what we can accelerate. And then from there, bonus rules apply. Under the current tax law, there's 100% bonus, meaning anything that can be accelerated or recategorized into the shorter life cycles is eligible to be written off in that first year.
Okay, that makes sense. So how long does a study like this take? Because you said you have to have an engineer that comes in and studies the house, right? So what does that look like? They come in and they look through your house and they say, okay, there's carpet here. This is something that depreciates. There's the cabinets that are going to depreciate. And they make a list of everything. And then do they have some sort of guideline of this is how much this is worth? And then how long does that process take? And is that kind of like what it looks like?
Yeah, you got really, really close to the overall process. In general, like start to finish timeline is anywhere between like 3 weeks to complete the full detailed study to 8 weeks, depending on time frame of the year, right? As we approach deadlines for tax seasons, we tend to get an influx in work, which creates a backlog of some things we have to work through and prioritize. But we really shoot for like a 4-week turnaround once we have all the documents from a customer when we've started a project. So 3 to 5 weeks on average. When you start a study with us, we can do them either virtually or in person. The IRS, when it comes to, there's it's a thing called an audit technique guide that the IRS puts out for their auditors. And it's essentially a rule book for them. Like, hey, if you were to audit somebody and they had a cost segregation, this is what you would do. But it's a public document. So the kind of cool part about that is it inadvertently gives like a how-to guide for cost segregation firms to follow to make sure we're being compliant and have everything we need. So the IRS requires in-person visits for their auditors, but they only require a site visit from a detailed study for like a firm. So all that means is we can do it in person or virtual. Virtual will just be like you walk around with the camera and we collect all the video, pictures, and anything else that we might need to give to our engineers. And then our engineers go through tools where like insurance companies will use something like RS Means, which is a aggregator for construction data in the US. And we have a proprietary tool that we've built that does the exact same thing. And they will essentially build out what it would be to replace your house new and then prorate it against your purchase price, your depreciable basis. And then anything that we would categorize into a shorter life cycle gets those percentages. So that's roughly how the process works.
That makes sense. With the overall process, there's engineers and construction and everything, but it's nothing that has to be like taken apart, or they don't have to really go into like the bones of the house, right? It's basically just the pictures that they have to look at. And it's for the most part. So there's that, the IRS outlines like 6 ways to do a study. We focus on the 2 most detailed, which would be probably more applicable for your listeners. Like if you bought land and you built a new property, what you spend on building is your depreciable basis. And we would use the receipts. And that is the single most accurate cost segregation study you can do. The second most accurate is when we don't have those receipts and some of that info, we run it through and do the purchase price allocation process, which is an IRS outline process where you go through and you look at like, okay, what's the square footage of this? How much is this? Is this a premium tile, a low grade tile, whatever that may be. And we can assign a dollar value to it from there. Okay. With doing these studies, I have a few questions that come to mind. First off, if you're buying something, let's say you buy it below market value, are you doing the cost seg based off of, does it have to be based off of your purchase price, or can it be based off of what the actual market value is?
Very good question. It's always based off of the purchase price. The IRS will not let you depreciate something for more than what you paid for it. So if you find an amazing off-market deal for like 10% of its value, you should buy that. You should do whatever you can to buy that, because you can flip it around and have a massive margin that you can gain on that, which is really, really good. It may not be the best to cost segregate because you can only depreciate that value that you purchased for. So example, $1 million property, you can buy it for $100K. you should do that. And you're not going to be able to depreciate more than 100K. And if your land value comes in at 20, now your depreciable basis is $80,000. And it may not make sense to do a detailed study based on the cost to do a detailed study and the actual work it takes and really see a benefit from that.
Okay. That makes sense. So it has to be based on the purchase price and not of the value. So if you still want to buy the deals, but just not cost seg them. Does your company do other like tax saving work as well, or is it just cost seg?
We have some partners with some like R&D tax credits or some 179D tax credits, which are like efficiencies in buildings. It's by no means like my specialty, but we partner with some other companies that do that. I know.
Gotcha. Okay. So another question I thought of is when you're buying this house or you're building, whatever it is, does this have to be done in the first year, or could it be done second year, third year, or 10 years down? When's the cutoff for doing this?
No real cutoff, but there is absolutely a diminishing return, because when you buy a property and you place it in service, depreciation starts on that property, which, by the way, it's not optional. I've seen some people think that the depreciation and the deduction you get is optional, or they may not know about it. They're doing their own taxes. I don't know. Real estate taxes are complicated. Like, you should really have somebody help you with that. So some people would not take that. But when you go to sell that property, the IRS is going to assume you did take that depreciation. And so they're going to hit you with what's called a recapture tax on the back end. And, that's whether you took those deductions ahead of time or not. So if you don't take the deductions, you're getting dinged worse than if you did. So you should. We can talk about recapture further too if you want at some point. But so like when the straight line depreciation is started, you're taking that every year. If you wait to do a cost segregation, we have to prorate against what you've already taken. So the cost segregation is saying like, hey, this is what we would do in the first year. So your best benefit is always going to be in the first year. If we change that down the road, we do what's called a change in accounting method. It's a specific form that you fill out with the IRS, and it allows you to change that and take the benefit in future years. So you can wait. It does cost a little bit, whether you do that with the CPA or directly with us to do a 3115 to do that change in accounting method, but you can take the benefit down the road. But if you have had the building for a really long period of time, 10, 15, 20 years, you're not getting nearly as much benefit from this as you would otherwise. Mm-hmm. I mean, the whole process of cost segregation is just accelerating depreciation up front. So the longer you wait, the worse it is.
Yeah. Okay. So you could still, for me, I'm just thinking it's, you might be busy buying deals and then you can worry about it. It's like a second step. It doesn't have to be like right when you close that you do the study. It could be 6 months down the road and still have a good value with it. So
yeah, correct. Okay. It does have to be done before you file your taxes. So if you do an extension, it's just due before the extension needs to be filed. It goes with your taxes. It doesn't have to be completed in like the year you purchase it by any means.
Cool. So then talking about later on, let's say when you go to sell this house, if you choose to, how does that work for them for paying it back? Because then you have basically that tax bill that you owe, right? Is that how that works? Mm-hmm.
Yeah. So there's two parts of that. First one is if you're going to do a 1031 into a property where you're rolling funds from a purchase into another property, right? The 1031 mechanism is assuming you have a third party that's, official to handle the 1031 exchange. They're the ones that handle the money from one property and roll that into the next. And there's rules on the time frame you have to do that transition. If you do a 1031, any capital gains or recapture from depreciation you've taken is deferred. And so when you sell after you've done a cost segregation, or whether you haven't done a cost segregation, you have that recapture test. So if you don't do the 1031, you'd be looking at recapture. If you did the whole 27 years, if you own the property for 28, whatever years you've owned it, and you did a cost segregation in one example and you didn't do one in the other example, the recapture would still be the same at the end of the day. It just changes what we're accelerating. The recapture math gets a little complex. We get kind of into some things that you typically is calculated by a CPA, but how much recapture you actually experience can vary. There are ways to kind of arbitrage the difference. So like, let's say you're in the 37% tax bracket when you first do a cost segregation, and then you leave your W-2. So now you're in a lower tax bracket. You're retired. You're just a real estate professional now. Great. You've kind of fulfilled the dream.
Quick break for a read from our sponsor. This episode is brought to you by Direct REI. Look, if you're a real estate investor, you know leads are the most important part of the business, but finding and following up with those leads is time-consuming and expensive. Direct REI solves that issue. It's an AI acquisitions platform with a built-in CRM, and here's what it actually does for you. It sources the leads straight from the county property records, it skip traces and enriches your data, it writes your sequences and runs your campaigns across email, text, direct mail, and phone, where you can send tens of thousands of outbound messages per month for less than the price of dinner, all from one dashboard. It tracks every channel so you know exactly what's working and what's not. And when a deal comes together, you can send contracts and collect e-signatures right there in the platform. And here's the real kicker. You don't have to run all of that yourself. There's an AI acquisitions manager that's built in that operates the whole thing for you. It finds the leads, it launches the campaigns, it works every channel, and when somebody replies, it drafts the response back in your voice so it actually sounds like you and not a robot. It runs your entire pipeline in the background day and night and only taps you in when there's a deal that's worth your attention. You stay in control, you close the deals, it handles the busy work that's been eating your nights. There's a free plan available, so you're not risking anything to try it. Go to directrei.com, hit try free, and let us start finding you new deals today. That's directrei.com. Now back to the show.
That I think a lot of us real estate investors want to do. Then you're probably in a lower tax bracket, maybe 25%. Well, if you sell that property then, the recapture is going to be at your income level when you sell. Example, you'd be capped at 25%. So you've just arbitraged your tax rate across different years, which is going to keep more in your pocket, which is pretty beneficial.
Okay. So if you, going back to the first thing, if you do a 1031, you can push that over to the next property.
Yep.
Okay. That's cool.
It's just kind of kicked down the road. If you sell, that second property and don't do a 1031, now you've kind of got recapture from both that you're subject to. If you keep 1031ing it into the next property and then I've heard it called dying with your boots on, right? Like you die, you own the properties, you have an inheritance to your kids, there's a step up in basis as long as you've structured everything correctly. And that recapture and capital gains is wiped and they have a new basis in their properties.
Okay. So is that what a lot of people do? They hold on to it and they pull money out from the property and then they just keep it till they pass away? And
I've seen some people like that's the goal, right? Mm-hmm. You can always start with a goal, but I always like, what is it, Muhammad Ali's quotes? Everybody's got a plan until you get hit and then you got to figure out what you do. So who knows what's going to happen down the road for them. And what I've seen other people do is they'll call it a lazy 1031 exchange. So the 1031, I think you have 45 days to make like a deal and then like to start a deal and go into contract, and 180 days to close. And if you don't close within that time frame, then that 1031 is lapsed and now you're subject to the capital gains and recapture. So I had a guy that happened, like the deal fell through and it wasn't going to work. So now he's got capital gains and recapture. Well, he's had a good portfolio. He had some of their cash and he bought another building, cost segregated that, accelerated all that depreciation and offset the capital gains and recapture from the other one. So he still had a net neutral impact on his taxes within that tax year. And now he has another property that's appreciating in value that he's leveraging and cash flowing.
Okay. That makes sense. One thing I think I forgot to ask at the beginning or bring up is to do this, you do have to be a real estate professional, right? So what qualifies somebody as a real estate professional, if that's true?
So you get a really good benefit as a real estate professional, but you do not have to be a real estate professional in order to take advantage of this. Anybody can really do it. So where we get into what real estate professional is, I'm going to kind of back up and talk about some other things first, and I'll circle back there. So we talked initially with that example, it was like if you buy it, it's a long-term rental, it's just going to be passive income. Well, passive income and deductions or paper losses from passive income can, or from an asset, it can only offset the passive income. So like if you have multiple properties and you're maybe making $100,000 a year on your passive income and gross revenue from a property, and we do some cost segregation, and you maybe, if it's multiple properties, you might get like $500,000 in a deduction or something we can accelerate. I'm just kind of pulling arbitrary examples, nothing real life right now. Mm-hmm. Well, we can't exceed the income from the passive source of income. So you would have $100K income that year that's wiped and then a $400K carryover from the deductions that were unlocked from the other cost segregation. That carries forward and just kind of chips away until it's gone. Where it becomes really, really, really powerful is if we can unlock the passive losses, or if we can unlock the losses from accelerated depreciation to your active income, where we show you're actively involved in the real estate in some way. Now we can offset your W-2 income. So if you have a day job and you're making we'll use 300,000 a year, just because it's easy. I'm not saying like these are the only people that can benefit from it, but it just makes it easier math, right? Then you're in a higher tax bracket. You're in like a probably effective tax rate of like 28%. Making 300K a year. Well, now if you are actively involved in that real estate, any deductions we do can offset that active income. We can drop your active tax rate. So it's a much better impact to you. So there's really 3 ways to do that where we can unlock those losses to their active income. That's going to be through the real estate professional status, which you mentioned, what's called the short-term rental loophole. And if it's like a business that owns the property, let's say you have a lawn care business and you have a facility and it's grouped the right way, then you can unlock the real estate for the owner of the business and the owner of the building to work against your active income too. That's called the grouping election.
Okay.
For the real estate professional status, kind of back to your original question, like what qualifies that? The IRS outlines specific rules on what it means to become a real estate professional. For the most part, you're a real estate agent. You're typically like a 1099 employee. You're a contract person. You make your own income and you're working like 750 hours a year and you're actively involved in the transaction, management, development of real estate. And then you can obtain real estate professional status.
Cool. That makes sense. So the key benefit then from that and the other 2 examples is you can use that against your active income instead of just passive income. So
yep.
Right. That's okay.
Yeah.
Cool. That
and
makes sense.
So we've helped some clients where like they're a physician, they have a W-2, their wife is a stay-at-home mom, and we work on getting the wife real estate professional status. So they run a portfolio. The doctor gets to kind of do the fun part that he likes is like the making of the deals, and the wife would kind of run everything and go to the properties and take pictures or help. They can also make deals. But because they're married finally and jointly, the benefit from that affects the physician's income. So they might be making $1 million a year in one aspect. They have a real estate professional status on the other side, doing some transactions, and they could get a lot of deductions unlocked. And instead of being taxed at $1 million a year, instead they're taxed at $500,000 a year or $600,000 a year. So
okay, and that's just like a more specific. So that's on active income. So like, let's say if I had another property that I sold and that's a capital gains, can you not use that against capital gains? It has to be just active income?
Kind of depends on how what the capital gains was for. If you were actively involved or passively involved on whatever business or real estate it was that had the capital gain event. If you're involved actively, then it's going to affect your active taxes. If you're involved passively, it's going to affect your passive taxes. So that's kind of taken into consideration too.
Okay. So it's kind of a by case on that scenario. That makes sense. Cool. So when does it make sense to do a cost seg? Like at what price point does it become worth going through a study versus is it not worth it? Like if you're buying a $100,000 rental home, is it worth it at that point? Or is there kind of like a cutoff that you guys recommend where it's more worth it?
Yeah, definitely. There is like a cutoff. I mean, I actually just helped a guy that's moving forward, and his depreciable basis on like 7 properties that we're doing with him was like $120,000. So like he bought them for 50, put 70,000 into it, kind of is doing the BRRR method on his real estate, and you get a lot of extra value add on the appreciation, but we can't depreciate more than what he's putting into the property. So that's a pretty low depreciable basis. That's kind of on the low end of the spectrum of what I would consider even worth it. I'll also say like we do free estimates for anyone. So that I think that's the best way to understand what it looks like based on a specific property. And I've done them for investors that haven't even acquired the property yet. Like you can send it to me. We'll take a look at it, look through, talk whatever it is. And then if you're like, yeah, I don't think I'm going to make an offer on that because some other things didn't work out, like no worries. But then that gives you an understanding of what it looks like. Where it really, really, really starts to make sense for what we do, which is the detailed engineering studies, those top 2 most detailed things the IRS outlines, is on the higher depreciable basis properties, like really over 1 million, 2 million, 7 million. The cost to do the study to the benefit you're going to get in your taxes is very advantageous. Like you get a huge benefit on your taxes compared to what you're going to be paying us to do this study. So on the low end of the spectrum, I try to shoot for like every dollar you spend with us, you're going to get $10 to $20 in tax savings. as you get closer to like that $1 million range, it'll be, I try to push that towards like $30 in tax savings. And when you start getting into those really, really big properties, the commercial real estate investors, just because of the amount of work that goes into it based on the purchase price, you're going to be getting like for every dollar you spend, maybe $100 saved in taxes or more.
Okay, that's a good guideline. You don't have to talk about like your specific pricing, but something like this, is it, for somebody doing $100,000 house, you said that'd be like $1 in savings or $20 in savings for every dollar spent. So it's not going to be in comparison. Like, I'm trying to figure out like what pricing looks like without you having to say your pricing, because I know it varies depending on on what it looks like. Yeah.
Yeah. So I know we've talked about it on other shows before, and kind of like, when a show launches, prices are subject to change as we're going through inflation. Right now, our prices start at $2,750 for a detailed study. I know other firms out there that are doing what are called engineered backed studies. They're also considered a modeling study. It's a much less of a result. Like, instead of 25% accelerated, you might get like 18% accelerated in the property, but those are much lower costs. And so the firms that are doing, I think it's a good thing for some investors if price is really an issue up front, because you do have to wait until you file taxes to get this money back, right? So you have like a kind of a cash crunch depending on your timing with that. But they're doing for much less, like sub $1,000 to do like a DIY study or these modeled studies where you upload some things and you get some things back. So the more detailed you go with the study, really the better the benefit's going to be. Different firms have their different structure with how they do that. Try to be as aggressive as we can while maintaining as much IRS audit compliance as we also possibly can. So we look at case law, we're looking at all kinds of previous examples, different guidances the IRS has put out on how things are articulated. And we build our stance around that so that we can accelerate as much possible depreciation as we can for those investors, give you guys the best benefit.
Yeah. So it is like you really get what you pay for, where if you're going through a more detailed study, you can get a lot better tax benefit versus one that might not be as detailed. You're not going to get as much back in general.
Yeah. And it really how much the depreciable basis is really like the key. And if you want to rule.
Hey, hope you're enjoying this episode. I just want to take a minute to tell you about Sell the Earth. Sell the Earth is my land investing program where I teach the exact systems I use to buy and sell land every single day. My team and I complete over 100 land deals a year, so everything you learn comes directly from what's working in my business today and not outdated strategies or theory. One thing that makes Sell the Earth different is it's constantly evolving. Real estate changes, marketing changes, and AI is creating opportunities that didn't exist even a year ago. As our business grows, the program grows with it. We continuously update the training with the newest strategies, AI workflows, automations, and marketing techniques that we're actively using to find more deals and operate more efficiently. When you join, you're not just buying a course. We meet every week on live coaching calls where you can ask questions, review deals, and learn from other investors and myself. If you want more personalized guidance, we also offer one-on-one training to help you overcome roadblocks and accelerate your process. Whether your goal is to close your first land deal, create another stream of income, or build a full-time land investing business, Sell the Earth gives you the systems, support, and community to help get you there. If you'd like to learn more, head over to selltheearth.com. Now, let's get back to the episode.
Thumb on what the depreciable basis is. Just use the purchase price of whatever that land is, like whatever the property is. The difference is like we're subtracting land from the depreciable basis, but if you don't know the value of the land or you can't figure that out, like not a problem. Just use the purchase price and that's roughly going to be. So the more you spend on a property, the better the return is.
Okay.
Yeah, it's pretty common.
Yeah. So I do land, right? What scenarios does this work for land? So it's new construction is going to be the case where you could see this making sense, where somebody's building a house or a rental property or something on land. That would be one case. Is there anything else you can think of? Like, how could you relate it to a vacant land business?
Yeah. So I think the one that everybody else thinks of is exactly what you just explained, just developing the land into some sort of rental property. That can work. One that I haven't done, but I know will work is if somebody did like a glamp ground on something. Like you're putting up temporary structures. We could really heavily argue that all those structures are temporary, and therefore the full price of what you spend on those units would be able to be accelerated. So you'd be able to write off whatever you spent on those things as a tax deduction on your income. Mobile home or trailer parks do really, really well. You're essentially putting like a pad there and allowing people to park. That's just kind of assuming you don't own the units. If you own the units, that can also still be really beneficial. If the axles are left on your mobile home, you're going to get we can argue more successfully that those are temporary units and they could be moved. So we can accelerate more of the property than if you remove the axles and put it on a like more permanent foundation. Those are probably the best ways to do that. One really interesting caveat, there's 3-ish properties I know where you can, whatever you spend on your purchase can be completely written off in the first year. And that would be like a car wash or a gas station are the two biggest ones. So as long as there's certain rules you meet for those two categories, you can write off the complete purchase in the first year, which is unreal.
Including the land value too? Or
the land, no, land is
not
still
the land.
removed.
Okay. So, just the entire cost of the structure, you can do the entire thing, like not 20 to 30%, like the
entire thing. Yeah.
Oh, wow.
So the great example, I was just about to respond to an email when we hopped on the call here, where a guy had reached out. He's buying a car wash in like Pennsylvania. It's a Love's car wash, LUV. If you guys have ever seen those, it's like the full drive-through bay. There's probably like disco lights and all kinds of fun stuff in there. And it's a hefty purchase, like $5.5 million. And the land value is like 20%. And so I'll just say it's $5 million. So he's getting $4 million as his depreciable basis. And we're going to be able to write the complete structure off in the first year. So the whole building, everything there is going to be considered a 15-year site improvement instead of the 27 or 39 year that it would be for commercial. And because of the 100% bonus rules under the current tax law, he's going to be able to write off $4 million on his pre-tax income.
Interesting. Is that why so many car washes pop up all over the place? Is that
maybe? Maybe. I don't know.
Because I've heard they've become a lot more popular recently. And I heard it was because you can buy the land, the space of the land in like a very wanted area. And the car wash covers the costs of owning that area. But then in 20, 30 years from now, the idea is that land's going to be a lot more valuable and you'll be able to sell it for more. But I guess if you can put that on top of having a cost seg that's going to be depreciating 100%, I mean, that makes it even more attractive. So interesting.
Yeah. That's definitely one. The gas station also very similar. You can argue that a lot of gas stations, there's some rules where like the square footage of the retail space can't exceed like a certain amount of the pumps and things. I'd have to refamiliarize myself with that rule. But the other one that I find really, really interesting is like McDonald's of all places. They have a specific agreement with the IRS because like McDonald's as a corporation owns all the land, right? They're actually the largest real estate owning company in the world. And so all the franchisees are building the buildings on the land. And so they've successfully argued with the Supreme Court that the building that they put on that land is temporary and can be fully written off in the first year as well. So if you were to own a McDonald's, like that can be written off. So there's fringe cases like that around, and depending on like how you buy a business or buy a deal, like there could be different things with that. If you bought a business and it comes with real estate, cost segregation can be very viable. But the really big ones are going to be like your mobile home parks, your gas stations, your car washes, some restaurants. We've helped the dentist's office where like a bunch of the chairs in the acquisition were on the floor. And so that was all included too. That helped accelerate.
Interesting. So. Yeah. Well, so there's a lot of little cases where if somebody's not sure, they could reach out and see like maybe there's something specific they could do.
Yes, absolutely.
Awesome. So one more like a personal question. So I've been personal for me. I've been thinking about developing a campground, like an RV park campground. And that's something where if I were to put the road in, put in the camping pads and water, electricity, what of that is able to get written off? Is it like my costs put into the development? Because I mean, a road's going to last a while, but I suppose there's stuff you have to repair the road. So like, what can you depreciate with that generally?
Yeah, like what qualifies, what doesn't qualify, is what ends up in what bucket. It's a really good question. So for the most part, everything you're going to do on developing land to become a campground. You're going to be doing site improvements and not necessarily like you could add real property. There could be some outbuildings in various places. Those would be considered real structure and have to fall into the long life depreciation of a property. But roads fall under what's called site improvement, or it's a 15-year. If it's a really, really permanent road and for whatever reason you wanted it to be long life, you can certainly argue that. I can see an argument for some people on the back end of how you're put with recapture. But I think in that argument, people aren't considering the time value of money, whereas like $100 today is better than $100 down the road. So, cost segregation as a practice is really the pursuit of the time value of money and getting that more upfront. So all those things are site improvement. The electrical infrastructure, like if you're going to do hookups and plumbing hookups, some of that would probably fall under real property, but any kind of roads, pads, like picnic tables that you would set up, fire pits, anything like that, all of that's just going to be considered site improvement.
Okay. Even though they're not like attached to the ground, right? A picnic table, something that can be moved, that still counts as improvement.
Yeah, I mean, when you're doing this as an investor, you're running these things as businesses, right? And so these are expenses that you would be able to write off through those business taxes. So like a picnic table is kind of considered furniture. Now, depending on how you invest in it, there might be a better way to write it off than through a cost segregation. So there's a clause in the code called the de minimis. It's Latin. It's known as the safe harbor clause, where like any individual line item under $2,500 can be written off in the first year rather than being capitalized or put into a depreciation schedule. And so a lot of times like furniture like that, like a table, a picnic table, that would fall under the de minimis thing. But larger things, like if you bought a campground and those things weren't itemized out, we could still capture that. It would be part of the things that we could accelerate.
Okay. And then generally from that, you would see from the things that can be depreciated, about 29% of that would be something in the first year on average, or is it a little bit different than houses and other types of land or real estate?
Yeah, it would be a little different, right? Because you're probably one of your biggest expenses would be like the road infrastructure to your different campsites. So that's going to be a pretty pricey ticket item. You bought the land's not depreciable, so it's only going to be what you put into developing the property. So any of those site improvements that are getting better is going to kind of go into like the depreciable basis of what you're creating. So ratio rise, when you don't have structures in that property, the amount you put into the road is going to carry a higher ratio. You'll be able to write more of that off than otherwise. So it may not be 29% in this case. It might be something closer to like 40 or 50% that you could write off from what you put into it. It just depends on what you're putting that money into specifically.
Yeah. What if I had a campground and I put a car wash on the campground? Can I write it off all the way then?
Yeah. So that could be really interesting. So the full thing may not be written off, but you're still going to get something like 60 or 70%. It's still going to be like really, really, really high.
Yeah.
From what you normally would see because of that car wash.
Okay, cool. Interesting. Well,
yeah, put a McDonald's right in the middle of the campground and ever. Not quite the case.
Cool. Well, if somebody wants to reach out about doing a cost seg, where's the best place to reach you guys, and where should they find you?
Yeah, so I'll definitely get you a link for our show notes, so you can click that link and fill that out and connect with me. You can also email me directly. It's chris.p@mavencostseg.com. And I'll be more than happy to answer any questions you have. One of our core values here is to make sure we just help everybody educate on whatever level they're at, whether you're a really sophisticated investor or whether you thought cost segregation was this kind of fringe thing, you've never heard of it. Like, we'll meet you wherever you are. I'm more than happy to talk about it.
Awesome. Cool. Well, I appreciate you coming on and sharing your knowledge. And I think eventually when I build my car wash, I'll know where to go. So I appreciate it.
Go.